I'm sure all of you are aware of profit sharing Islamic investment accounts offered by Islamic banks around the world. When Islamic banking started, the profit sharing investment accounts offered by Islamic banks, they were based on Mudaraba. There were two types of profit sharing investment accounts: restricted profit sharing investment accounts and unrestricted profit sharing investment accounts. Referring to a profit sharing, unrestricted profit sharing investment account, an investment account holder puts their money with a bank, in this case, an Islamic bank, and the relationship between the investment account holder and the bank is governed by a Mudaraba contract. This money is put into a Mudaraba pool. In most cases, the bank mixes the money contributed by the investment account holders with the money contributed by the shareholders of the bank in the form of shareholders' equity. That combined money is then used by the bank to do a lot of investment activities. Strictly speaking, we shouldn't say investment activities. These are investments, but these are financing activities. The bank uses the money in Mudaraba pool for funding its financing activities, and we call those activities for our convenience as investment pool. So that investment pool generates return. So gross return or comes from the investment pool activities, and that return should be partially given to the bank as bank's share. Remember, the bank is using investment account holders' money and the shareholders' equity. So the return generated by investment activities would be divided between the shareholders and of course the investment account holders as well. In addition to that one, the bank managers or the bank management would receive its Mudarib's fee or Mudarib's profit share. Investment account holders, they are Arbabul Mal, or they are the owners of capital. At least part of the capital that goes into the Mudaraba pool, and the bank management serves as Mudarib. So bank's share would actually comprise the Mudarib's share in the profit and the profit share of the shareholders' capital invested in the Mudaraba pool. Part of the return also goes to investment account holders because they have contributed money into this Mudaraba as well, and that could be considered as a gross return on investment accounts. In reality, however, in case of unrestricted profit sharing investment accounts, the profit distribution doesn't take place like this one. So once the investment pool or the financing activities generate some return, part of that money, a small amount, in general, this is about 5%, that goes into a reserve that is called profit equalization reserve. Once some money out of the return has been set aside in the profit equalization reserve, bank's share is then distributed. After that, some money can still be contributed to the investment risk reserve, another reserve, before actually in accounting stage 4, the net return to the investment account holders is distributed. So these are 4 accounting activities. Once the profit, gross return is generated by the investment / financing activities, number 1, part of that return is set aside in the profit equalization reserve. Bank's share is then paid out. And after that, some money goes into the investment risk reserve before, at stage number 4, the investment account holders, they get their return. All this is done because the bank would like to do what is known as profit smoothing.